Hello everyone and welcome back to our channel. Today is the next video regarding education for finance and stocks. We covered the introduction to stocks, ETFs and what are the finance itself. Today I want to talk about how we are measuring if the stock is good or bad. How we are analyzing the information, what information we are analyzing, and what gives us a more or less precise picture of what this stock is about and how it is doing. Without further ado, let's proceed. So first metric that we are going to cover is the PE ratio, price to earnings. It shows how much investors are willing to pay for $1 of company's earnings. Let's start with an Apple. Rings a bell, doesn't it? We can see here price earning ratio is 38.93. It means that each investor is willing to pay around $39 for $1 of Apple's benefits. Is this a good value, 38 or 93? A threshold for PE is between 15 and 20. 15 and 20 considered reasonable for most of the industries. A very high PE above 25, it can show overvaluation unless it's justified by the growth parameters. So in case of Apple, it's really hype stock. It has grown. Really, we can see that market cap is 3.6 trillion, which means $3,600 billion. And looking for the 1 year, we can see it's growing. And looking over 5 years, we can see that it's constantly growing. Like for 5 years ago, 2020, the COVID year, this was the COVID correlated degradation of stock price, but overall we can see that it's continuously growing, and comparing to 5 years ago, now it's 2.2 times or even more, 3 times higher than it was 5 years ago. So we can say probably that the price to earning ratio is justified in case of Apple. Next metric is earning per share. Let's check if Robinhood has that information. Earning. This shows earning per share. Higher EPS is better, of course, but should grow consistently year after year. We can see here that it fluctuates within the same range, from 235 to 150, and also we can see that year after year values, like here around 157 and a bit north of it, are showing the growth. Q3 is showing more or less the same. Q1, we see the projection of Q1 for financial year 2025 is again good, and Q2 we don't have anything to measure here. So yeah, we can say that this is also justified. Next metric I want to talk is price to book ratio. This compares the stock market value to its book value, like market price per share, book value per share. Do we have it? No. Let's check it. P/E ratio Apple. In later videos you can see that we are getting the data and by calculating it. So price to book ratio as of January 7, 2025 is 64.77. What is the good threshold for it? A value below 1 suggests the undervaluation, especially for asset-heavy industries like banking. Ratio between 1 to 3 is between 1 and 3 is typical for many industries, and the high PB might indicate overvaluation unless justified by strong growth. So in case of Apple, we saw the growth and we can say that it is growing. Next metric we want to talk about is dividend yield. It measures how much company pays in dividend relative to stock price. The formula of it is annual dividends divided by stock price. It's great for income-focused investors. And dividend yield of between 2 and 5% is considered attractive for income investors. A very high yield can be risky as they might indicate financial instability. Now, let's check what is it for Apple. It's 0.41 for January. It's close to the dividend yield of 2.5 between 2 and 5% for income investor attractiveness, but it's far away from very high yields above 6%. So this also shows financial stability of the company. After that is return on equity, ROE. The threshold of it above 50% is considered strong. Consistent ROE growth year over year is a positive sign. And what does it measure? Measures profitability relative to shareholders' equity. The formula is net income divided to shareholders' equity. Let's check this. Return of equity is considered 137%. As we just discussed, above 15% is considered strong, and this is way above 50%. So what's next? Next is debt to equity. From the name we can understand that it's showing proportion of companies financing that comes from the debt. Its formula is total debt divided to total equity. Let's check the value for Apple. It's 1.51. Now let's check let's understand what does it show. It shows that the company has $1.51 debt for 1% of equity. A threshold higher than 2.5 is considered excessive debt and financial risk. A DE below 1 is generally preferred, like 0.5. For capital intensive industries like utilities, a DE up to 2 might be acceptable. So this is that. Free cash flow. The naming says it all, and the meaning of it is cash that company has left after expenses and investments. It's like calculated cash flow from operations minus capital expenditures. It's important because it indicates financial health and ability to fund growth or pay dividends. Now, what is the acceptable threshold of it? It should be positive. And best of all is looking for growth over time. Higher free cash flow as a percentage of revenue, 10% or more, is a strong sign of financial health. Now let's check what is it for Apple. We can see that this shows on a quarterly basis growth. There was decline in quarter 3, but overall we can see that this 2023 was showing decline in earnings, but free cash flow, and this one for 2024 shows strong growth. Last one, which I want to talk about, is market capitalization. Market capitalization is the one that shows what is the company's price on the market overall. It's calculated stock price multiplied by total outstanding shares. This criteria helps to categorize companies between large cap, which will be over 10 billion, mid cap 2 to 10 billion, which shows growth potential with moderate risk, and in case of large cap it's stability and lower risk. And the small cap below 2 billion, it's high risk but higher potential returns. Now for the Apple, as we just checked, the market cap stands for $3.6 trillion. Means that it's way above the stability grade and can be considered as a stable investment. Now, what will be good for you to continue? Analyze all the metrics for other stock. Try to understand how good it is, or maybe even grade it. Like initially you can grade it for yourself in some tools. Later on in videos we will grade the company metrics as good or bad using the coding. I hope you liked it and this was useful for you. Stay tuned for the updates and see you next time. Thank you and bye-bye.